And you're on, like, Facebook and stuff. That's pretty cool. Are we live? All right. I love being live. It's just me. It's change of plans.
I'm trying to get the thing fixed. The layout thing. Screw me in. Oh, there we go.
Oh, nice. All right, we got it figured out.
Goodness gracious.
We're live.
We're live.
Oh man, I think so this is going to be a competition. It's going to be a production quality competition between Florida and Idaho, and maybe we'll have the audience vote.
Oh, that would be fun.
Quality of audio,
Yeah,
quality of video,
we're stepping our game up here.
production quality, intro songs, graphics. So
Are
all
we
right.
ready to go?
I think we are. I think we're live.
All right.
Pretty sure I can kind of see stuff. So
All right.
good to see some of the chats come in. Hello everyone.
We're live here from North Idaho. We've got a special guest.
Yeah.
Andrew, first
Yeah.
time in Idaho. What do you
All right.
think so far?
This is exciting. Yeah, Idaho. I didn't realize the difference between Coeur d'Alene and Boise. I guess it's a 9-hour drive. I just figured it's like, probably 20 minutes away.
Like I think Tampa and Orlando is.
Yeah, no, it's like a totally different. We're like way at the top of the state, and the other thing is the top of the state's really skinny, and the bottom of the state's really, really wide. It's a weirdly shaped state.
They call it the Panhandle. So we live in the Panhandle of Idaho.
Is there like a river? Like why is the Panhandle the way it is?
I have no idea.
Like,
we do have rivers and we have lots of lakes around.
Okay.
But we're sandwiched in between Montana and Washington.
Yeah. It's
So
it's an oddly shaped state. So
Yes,
I'm trying
it
to
is.
adjust.
Yeah. Well, we're happy to have you here.
All right.
So this is a special treat. Usually Kate and I do this together, but he is playing producer. He's spent quite a bit of time getting this all set up. So we're pretty excited to roll this out. Hopefully audio and the visual is good quality.
If you could see behind the scenes, you'd be like, what the heck
Yeah.
is going on? There's
And
cords
forewarning
everywhere.
Karen, if she's on, that you're going to be stepping your studio game up when you get back. So probably need to pencil that in the budget.
There's cords everywhere. So don't move.
Do not move.
Yeah.
Well, today we're going to pick Andrew's brain and get inside a fund manager's thought process and kind of his journey to get here. So tell us a little bit about kind of how you started Central Lending and where this all evolved from. What were you doing before you were in private money? I think that's an interesting story.
All right. So just starting with the open-ended question, how it all began. Well, depends how far back we go, but I guess going back to childhood, my family, my upbringing, a lot of job sites, a lot of Home Depot trips, a lot of, we were the family where every summer a wall was getting taken out, an addition was being put on the house. So I got a early exposure to real estate investing, and my family didn't do it professionally; they did it as more of an income supplement, but still getting that early exposure was something that kind of stuck with me. That early exposure as a kid. As a young adult, oh boy, is that me? Who's calling me? Get out of here! I swear I'm on Do Not Disturb. That's one of the. I'm on, right? Oh no, I'm not on. Uh-oh. I knew that was gonna happen. All right, we're back in. Please, now I'm gonna have people calling me as a joke to see if they can mess it up.
Don't call Andrew for the next hour.
Yeah. Am I on, Cade? I know my audio is working, so I'll just explain while you get the camera back on. So anyway, early exposure to Habitat for Humanity as a kid. When I was a young adult, I actually was a professional gambler. I played poker on the internet for about 11 years.
Wow.
So played 15 million hands of Texas Hold'em on the computer, kind of lived all over the world, did that. Um, Kind of realized in my late 20s this isn't the career path I want for my entire life, but I enjoyed being in a results based business. I enjoyed the challenge of being sort of self employed. Um, and so there were some there were some things that poker and real estate sort of had in common.
Yeah.
And so, you take a lot of calculated risk in poker, you take a lot of calculated risk in real estate, right? You buy a deal, you make a loan, you do something based on a future pro forma, you make a decision based on incomplete information. A lot of these skill sets translated actually pretty well. So I trained the way I think about problems through poker, but applied all that to real estate. So anyway, about 11 years in poker, moved away from that, decided for a lot of reasons I didn't want to do that for the rest of my life. Got into real estate, just jumped in with both feet. Started doing some own deals.
Yeah.
Got a real estate license. Did about 100 fix and
Oh,
flips.
wow.
Did about 50 spec homes. So I've been to job sites, been to Home Depot. Been party to a lot of different purchase deals. Um, so I've done deals, right?
Right.
I've kind of I know what it's like to need money for a deal. I know what it's like to have your contractor, uh, perform poorly. I've had my electric stripped on some of
Hmm.
my houses. I've had water heaters stolen. So I've gone through a little bit of that pain process that our customers go through. But I really wanted to move into lending because I thought it scaled better, and I thought it complemented my skills a little bit better than actually like hands-on flipping did.
Yeah.
So I'm more of an analytical thinker, more of a numbers guy. Also, lending tends to be lower risk than downright owning all the property and being
Hmm.
exposed to market value all the time. So I really like the lending side for a lot of different reasons. So we got into lending full time in 2019. We started lending very aggressively. So from about 2014 to 2019, we were a hands-on real estate owner operator, and then from 2019 onward, lending has been our primary strategy.
Okay. And when you started lending, were you lending your own capital or did you start raising money from investors at that time? Talk a little bit about kind of like how that started.
Yeah, so we've had a fund from 2014 and 2015 to 2016. I only invested my own capital,
Okay.
and this was savings from poker from a long time ago. In 2016, I reached out to a couple of buddies of mine, and I asked them. I said, "Hey, I'm doing more deals, running out of capital. Do you
Hmm.
want to come into a fund and participate in some of these projects I'm doing?" So a couple investors joined our first fund in 2016. That fund's been going for over a decade now. It's hard to believe.
Yeah.
But I used my own capital for about 3 years, and from late 2016, really 2017 was the first full calendar year where I brought in any outside investor capital.
Gotcha.
So from 2017 until today, I've been investing a mixture of investor capital and then my own capital.
That I think that's a really important component to talk a little bit about because not all lenders actually put their money where their mouth is, right? They're out there raising capital, and I think, to be honest, like I've been around a lot of fund managers, and I think that makes you very different because it is your own capital. I mean, it's not all your own capital, but you treat it like it is, and I think that that is a big differentiating factor, because, like I said, not all lenders lend their own money, and I've seen you underwrite deals, and we'll talk a little bit more about this, but you take it very personal and, you act like every dollar
Yeah,
that goes out there is yours.
it's I would rather lose my own money than an investor's money.
Yeah,
It's
I
pretty
agree.
it's pretty painful to make mistakes.
Yeah.
So
Talk a little bit about your family. Now, your family was educators, right? So your
mhm,
parents were
both
actively
teachers.
investing in real
Yeah.
estate during the summers. I love that. Was there anybody else or a deal or a mentor that made you kind of go the direction of private lending?
No, I think I just realized that being a fix and flipper, you're probably so on a this is how I thought about it maybe 8 years ago, and maybe probably oversimplified back then, but 8 years ago, I would think, okay, on an average fix and flip deal, a borrower might make, let's just say $50,000 on a good deal,
Yeah.
but it's going to take them like 100 hours of work, and they're going to have
Hmm.
to take on a lot of risk to do that. To do a loan, the lender might make $10,000 on that deal, but the lender might only have 10 to 20 hours into that deal. So I was thinking, okay, the lender doesn't make as much money as the borrower, but they're taking on less risk, and it's way less of a time investment into each project. So that was the attraction for me. I really liked the lower risk profile and then the lower time investment into each project.
Maybe I should take that advice. Active real estating is not for the faint at heart. Um,
But you could do very well in it, but it's just people underestimate the amount of time
it's a
managing the
lot of time.
contractors, cutting the
Yes.
grass, talking to the realtors, fielding offers,
Yep.
and lending's the same. I mean, there's a lot of things I didn't know that we have to do you know to protect the balance sheet, but it's being an active operator owner of real estate is more time exhausting than being a lender. A lender, good loans will, I don't want to say they service themselves, they don't, but good loans, the payments come in on ACH every month, draws go out upon
Yep.
request. Hopefully, it pays off in 6 to 10 months generally. So you're really focusing your time on some of the assets that are a little more distressed, but that's a small percentage of the overall pool.
Yeah.
When you're actively doing a deal, I mean, you have so many things to manage to make that project a success.
So tell me a little bit about like what your business model looked like maybe the first 3 to 5 years versus now. Like staff, like I mean, I know
Yeah,
you and you wear a lot of hats.
yeah, the first 3 to 5 years, it was me and one other person, employee number one. We would literally go in a car, drive around town all day, look at the next day's auctions, run our own title searches. So in Florida, any deal that goes to foreclosure, you can bid on it. And so we would drive basically all the next day's foreclosures in our state, and then we would do our own like pencil title searches to figure out if the title was clear or not, because these foreclosure sales don't come with title insurance, so it's kind of like a buyer beware, do your own homework deal.
Yeah.
So it was basically doing our own pencil searches and doing our own market research on the next day's auctions. And then what was really frustrating about that is a ton of these auctions get canceled like the
Hmm.
morning of. So you're driving like 20 properties, you're doing like 20 pencil searches to figure out, what is a second mortgage that you're bidding on, what has other liens that weren't in the case. So you're doing all this homework, and then like 14 of the 20 deals get canceled the morning of. So a lot of last minute redemptions, a lot of last minute bankruptcy
Yep.
filings, a lot of
Yeah.
rescheduling. So that got to be kind of frustrating. But it was just a lot of hands-on operations, lots of scouting properties.
And that was when you were heavily acquiring
Yes.
properties.
Hmm.
When you started more actively or really ramping up the lending side of it, what did that look like as far as the staff goes?
So lending, so same thing. We were pretty lean. It was so when I started lending, I went to every house. So I met every borrower at every property. I walked into every room, and it was a very like kind of I used a local attorney to draw the documents.
Mhm.
So it was a very localized approach where I would literally walk into every property, met every borrower at the house, would walk through the house, learn about what they were trying to do. Also, I could charge 4 points and 12% on every deal, which was amazing. So yeah, it was a very unscalable, but I was a sponge for learning how to kind of be in this different seat in
Mhm.
the same type of transaction.
Is there anything you feel like you did wrong early on that you would have done differently?
Hmm. I mean, my processing fee was like $500. I feel like
Oh
that
my
was too
god.
low. It's interesting because I think some of your best loans are when you go to the prop. I don't. I hmm. I probably could have grown a little bit quicker.
Mhm.
I think conservative, like going to every house, like literally going to every house is a little bit crazy,
And
right?
you were obviously just lending in Florida, right, at
Yes.
that time,
Yes.
which limits you a
Yeah,
little
and
bit.
now we're closing 15, 20 loans a week. We're getting 130 applications a week. We're qualifying 50, 40 to 50 deals a week. So now, and it's, all, in mostly Southeast and Midwest states.
Mhm.
So I think I could have probably tried to scale a little more aggressively. I think I was pretty conservative with sort of some of my growth aspirations.
Mhm. What did your staff look like at that time? Was it still just you and one
Yeah.
other person? And did you just outsource servicing and that type of stuff?
Um, what did we serviced in house on our first couple loans? Yeah, I think our first 6 loans, I serviced them, and then I remember when we started using third party servicing, and we started getting more organized. I had to like manually find these loans, and import the data, like backfill the data into my track record. Because
Oh,
you're across 6 years, you're in like different systems, and then the first 5 loans were like, first 5, 6 loans were like very manual. I serviced the first few myself before I learned about FCI and all this other stuff.
okay. And some people may not know this, but a big part of our business model is capital market partners,
Hmm.
right? So, for those of you that don't know, some debt funds will originate a bunch of assets and they don't originate anything new till somebody pays off, right? We have partnerships that are long time relationships that Andrew has created with capital markets, and we sell a lot of our assets. Tell me a little bit about how you transitioned into that, because that's also not always common with debt funds. When did you start working with capital markets, selling the assets off? Just to kind of put it in perspective, we collectively have about 32 million raised across our funds, and we'll close what, 120 million this year,
I th-
potentially?
I'm hoping a little more. I'm
Yeah,
hoping more like 150, 180. We'll see how quickly we heat up in the
yeah.
fourth quarter. So I'm definitely hoping for at least 150. I don't think we'll exceed 180, but I think it'll kind of be in that range somewhere.
But just to kind of give people a perspective of the velocity and the amount of times we turn that capital over, I'm really curious how
Yeah.
you really started working with those kind of
Yeah, so
partnerships.
people think like lenders are this like black hole of just money. That's like a pile of money that's always there when you need it. It shows up on the closing day, and like someone has to actually manage those accounts at the end of the day and look at them and make sure the the balances are there. So people just tend to think, "Oh, lender, it's this some big entity." Like, no, it's like for us, we're a small company. We're literally checking our balances every day, checking our pipeline.
Liquidity calls.
Yeah, we're checking our pipeline every day. We're looking at, we're projecting our fundings for the next couple of weeks. We're projecting our liquidity events for the next couple of weeks. We're making sure things are in balance. So we don't want too much cash, because then you have yield drag, which is not going to make your investors happy.
Yep.
We also don't want enough. We also need at least enough cash to fund our pipeline, because if we don't show up on closing day with a wire, we're going to make our borrowers very unhappy and potentially, blow up their deals. So there's a middle ground where that we have to live in, where we don't have too much yield drag, but we can, fund our pipeline without driving the back office insane. And so I spend a lot of time balancing liquidity with deal flow. I spend a lot of time obsessing over that balance. And to answer your question, there's a lot of ways you can kind of balance liquidity and deal flow. Deal flow can be manipulated a little bit, right? If you want more deal flow, you can market harder. You could pay your sales team more. you could lower your pricing, you could loosen your guidelines. And so there's these like levers you can pull. And then if you need, if you, and then if you want to, bring your deal flow down, you could raise your pricing, you could tighten your guidelines. So you can kind of do the inverse of those things. And it's, you really don't want to do like a whipsaw, like on off thing. You're really just kind of pulling the strings a little bit to make sure everything is in a nice harmony. On the capital side, obviously we raise capital. That's one way to bring liquidity in. We can also sell our loans. That's another way to bring liquidity in. We can sell real estate that we own. That's another way to bring liquidity in. We can pledge real estate we own, and borrow money from banks with mortgages against that real estate collateral. It's another way to bring liquidity in. We can pledge our loan assets on a warehouse line of credit. It's another way to bring cash in. So, and then something we haven't done yet, but something I'm learning more about is securitization. So that's another way to bring liquidity in. So there's all these different strategies, and you just have to figure out what's the right recipe for your particular company.
I think it's great that you commented on the leveraging because that seems to be a big concern out in the
Yeah,
marketplace with at least with private investors that we talk a lot with. Is leverage a lot of times people view it as being really scary and risky. I
yeah,
think if it's utilized responsibly, I think it's a great tool for a fund, but it does come up often. When you think about leverage and risk, is there anything, I'm sure there's a lot that goes through your head making those decisions as a fund manager. I mean, you fund to make the right decisions. Is there any type of a thought process that you go through when you're trying to decide if that's a good strategy for the fund?
yeah. I mean, leverage is risky. I mean, it just, if you're just going to be intellectually honest, it's risky. But it, leverage on leverage on a house you buy with a, like, there's different levels of leverage. So leverage on a house you buy with a loan is different than leverage on a loan with a smaller loan. There's like, so if the underlying asset is a safer asset, then leverage on that asset would, inherently wouldn't be quite as risky.
Mhm.
And then also there's levels to it, right? Like if you're a lender, you can get leverage on your loan book, you know, being at a 4-to-1 ratio versus a 2-to-1 ratio. Like these are massive differences. So it's very important how you manage that leverage. So if I'm a lender and I have, a $50 million of loans on the bank, $40 million of leverage, that's pretty high. If I have $25 million of leverage, 25 million of equity, a $50 million loan book, and then all of those loans are very conservative loans against, underlying LTVs on real property, and that's a different story. So it really depends on how the operator is using leverage. For us, we don't use leverage to sort of make like returns. We use leverage more as a liquidity tool. It really smooths out our liquidity. So for me, I anticipate the way I think about it is I anticipate our leverage to always be between 33 and 66%, usually around 50-50. Um, but leverage for me isn't a way to push yield from 9% to 13, so to speak. It's a way to fund, a $15 million pipeline with $5 to $10 of liquid cash. Okay, so it's a way to really smooth out those demands, those upcoming loans that we have to fund in our pipeline.
Love it. We get asked this that often.
Mm-hmm.
This kind of segues in dovetails off of what we're talking about, but do you think that you have you look at anything different or you operate any different way now that you have other people's money raised
Well,
versus when you had only your own
yeah, I
money?
want to talk a little bit about the lever. So one other thing I forgot to mention is like the the financial institutions that give you leverage are extremely sophisticated. So they're reviewing your audited financials. They're reviewing all of the loans you're pledging on their line. They're looking at a they're looking at my loan, they're advancing a percentage of my loan, then they're advancing typically a maximum LTV on a collateral look through basis. Then they're looking at my track record, right? They're looking at 3,000 loans we've done, seeing how those have done.
Mhm.
Then they're typically setting sub limits within that line of credit. So, like, I can only advance so much to one borrower, so much in one market, so much in one asset type. And then also, they have a network effect of another 20, 30, 50 private lender clients that they have. So they see kind of what's working in the market. And then so there, what I'm saying is there's a market there. It's not just the leverage is whatever I want it to be. Let's just say I couldn't even necessarily get it because you have really sophisticated banks on the other end of that trade, really kind of, you know, wanting to protect their capital. So there's a market that develops there where it's a natural check and balance.
There's also comments in audited financials as well
Hmm.
in relation to leverage and the structure of the fund.
Yeah.
So we push this a lot is work with an operator that has audited financials, and you get a pretty good insight as to what's going on from a third party.
Yeah.
Um, do you think you operate any differently now with more investors'
Yeah.
capital under management than you
Absolutely.
did before?
Yeah, I'm more conservative now and more concerned. When I so I give you an example. So there was one investor that when I wanted to start doing lending, there was one investor I approached, and he was generally on board, but he only wanted to lend in about 8 states where he liked those real estate markets. And I wanted to invest in like 30 states. I wanted to learn a lot of different states in the Midwest. So what ended up happening was his capital, we only, this is very early on, we only did loans with his capital in his 8 states. And then all the other states where I wanted to learn the market, I had to use 100% of my own cash. So I tend to lead with my own cash if it's like a unproven strategy, because I'd rather, kind of live with that result than have it. Because I think, I think protecting my track record is very obviously very important. So I tend to lead into a new strategy with my own cash. But to answer your question, I'm more conservative with investors' money than my own money.
I would agree with that. I've observed that. So let's get into the day to day. I've been here in December 3 years,
Hmm.
and we have grown a lot.
Yeah.
I'm curious, and I'm sure the viewers are too, is what does your day to day look like managing a fund now? I think it's changed in the time I've
Yeah.
been
Which
here.
week are we talking about? Okay. So right now, it's a huddle for 15 minutes at 8 o'clock, going over some of the software we're building. um, that whole space is crazy. Like a year ago, I did not think I'd be building software. And sometimes I have to pinch myself and say, you're not a software company. Like, don't get distracted. On the other hand, the technology is moving so quickly that I think you have a duty to really learn it and kind of make a business decision to adopt or not adopt, but at least learn sort of the technology that's out there. Because I think if you're an operator and you don't pay attention to the technology that's coming to the market, I'm concerned that you might get competed out by lenders, by operators that are maybe more efficient than you. So anyway, it's a long way of saying technology has become very important to us now. 3 to 5 years ago, I would have said, I don't really care about technology. Someone emails me a property address, I email in terms. If the title works good, we're closing a loan. Now, technology has become a big part of our
Hmm.
of our underwriting process, and just how we function as a whole. So I do a little call at 8 o'clock. I do a little huddle with my tech team. Um, Normally, early in the day, I'm reviewing deals. I look at all loans where a full application is submitted, because I want to control the types of deals that are going into processing. It Even if we have underwriting and processing, sort of killing bad loans. if you clog your pipeline with too much junk, it's really going to hurt your operational efficiency. Um, and of course, if we qualify a bad loan, maybe it could slip through too as well. So I'm very fanatical about the top of our sales funnel, making sure we only qualify good scenarios that I believe are reasonable situations to fund. And funny enough, Cade helped me today with,
Yeah.
I had him like, I put Cade in the qualifying seat. We looked at 10, we looked at 10 applications today. And after we got through like 9 of them, 2 new ones came in. So it's like a revolving thing. But I review a lot of loan scenarios. I'm very active in that at the top of the funnel. Day to day, it's a little bit different, but usually later in the day, I'm going to be reviewing difficult scenarios on files with our sales team. So
Mhm.
we do pipeline calls, and unfortunately, if you qualify a loan, you're really basing it off of information you can pull off, from third party services, but you're kind of limited, right? You don't have pictures of the inside of the property typically. You a lot of times you have like a stated credit score, maybe an incomplete track record. You have a scope of work. You kind of see the scope of work, but you don't have photos to tie it to. So, um, you know, I qualify deals with a lot of information, but we don't have all the information. And then sometimes things change in processing. Like
Right.
sometimes borrowers aren't who you think they are, or budgets change, or we get the pictures back and it's totally different condition than we thought the property was. So, something might pop up on title. So there's all these things that happen in processing where it might be like an edge case or an exception that needs a decision whether or not the file has enough mitigating factors to justify proceeding or decline the loan or whatever. So, um, a lot of quality control in sales and processing right now. We are staffing up in those departments, and
Mhm.
so I'm hoping, once we do that, I can move more to some other things. But right now, I spend a lot of time trying to make sure we don't close bad loans because at the end of the day, um, there's a lot of bells and whistles in, private money lending and in fund management and all this kind of stuff. But at the end of the day, like you just back to basics. Like you have to protect your capital. You have to spend less money than you're bringing in. And, I know there's tech and all these other things. It's just, you just can't get distracted from those guiding principles. So I think a lot about just, okay, I know things are tough, maybe frustrating, maybe fast paced, maybe each day is a little bit challenging, but like, I try to I always just try to ground myself and think, at the end of the day, let's just protect the money and spend less money than we're bringing in, and we will be okay.
Yeah. I was impressed with the quality control, I have to say. I was introduced to you from a mutual investor that bought a lot of notes from you, also had done some business with me at my previous firm. And I had asked about your track record as far as like a default rate goes. And I honestly thought he was lying to me, trying to convince me to come to work with you. And you and I talked for probably a year before I came on board. And I will say that the level of quality control is what impressed me. Like there are shops that are riskier shops, and there's nothing wrong with that model if you have the infrastructure to manage it. You have a full legal and a very robust servicing team. I mean, there's opportunity in that, but it's a pretty exhausting model, and it's risky.
Yeah.
I
Yeah, I mean, like, I looked at a deal with Cade today, and, like, it was either a horrible deal or just a fraudulent deal. I'm not sure which. I'm leaning towards fraudulent, but yeah, we really dig in. I mean, it was a borrower who, and I'm not gonna do any specifics, but it was a borrower who basically a year ago had never bought a property. And in the last year, they've taken out like 10 loans, uh, you know, 4 different lenders. Um, like 6 of the 10 deals they bought off the same seller, and then that seller was in foreclosure with a competing hard money lender. And then the price that seller paid a year ago was this, call it 150, and then now they're paying 220 a year later, and no real improvements to the property were made. So there's a lot of there's just a lot of not. So I tell this to new lenders, especially. A lot of the bigger guys get it. A lot of the smaller lenders aren't as sophisticated. So I think smaller lenders sometimes can be a target.
Hmm.
But there's a lot of just fraud and straw borrowers and non-arm's length transactions in our space. And if you really don't understand the story of your deal, you're going to get hurt. So it's of a paramount importance. A lot of Not all 750 credit scores are the same. You can have a 750 credit score with a Capital One card,
Yeah.
and a $300 balance that you've paid as agreed for 3 years. You can also have a 750 score, with 15 mortgages paid as agreed across 20 years.
Yeah.
And so we really dig in, and try and understand what's a real credit score and what's a thin credit score, what's a real deal and what's sort of pretending to be a real deal. But you have to dig into the non arm's length transactions, and the straw borrowers. 90% of our due diligence is focused on preventing mortgage fraud, which I think is where you take your big losses. The other 10% is in keeping new borrowers out of trouble. Your professional borrowers, generally they know their market, and generally you need to get out of their way and just make sure everything's on the up and up. But uh, most of our underwriting efforts are in just preventing the big losses.
So you guys looked at 11 or 12 this morning because I
Mhm.
was sitting in there with you. Of those, how many did you actually qualify?
So I think we qualified two.
Of
I
11 or
think
12?
we declined two on the spot, and I think we sent 7 back with more questions.
Of a percentage of loans that apply for funding from us, what do you think the percentage is that actually close?
Yeah, so it's like an unpopular. I hate answering this
I
question
know.
because the borrower's like, "Oh my god, he's gonna blow up my loan at the end," and it's unpopular brokers, and then the invest. So it's like your investors want to hear that you don't ever fund
Yeah, yeah.
anything.
Yeah.
Yeah, we look at 5,000 applications and we fund one deal. That's what your investors want to hear
Right.
on the capital on the passive side. And then the borrowers and the brokers want to hear that
We
if you
fund everything.
yeah, you look at 1,000 deals, you fund 1,000 deals, right? So the truth is, we bring in about 130 quotes per week, and we close 15-ish loans per week. So there's probably like a 10-to-1 ratio between quoting a loan in our system
Yeah.
and closing a deal. Now my job is the way I view my job is to very quickly give the borrower good feedback that they can count on, because borrowers sometimes have hard earnest money on the line. Sometimes sellers need the money for another deal. There's real consequences to stringing a borrower along and then dropping them a day before
Yeah.
closing. So we've designed our company in such a way where we can give news quickly. So we really want to ask those clarifying questions up front so that we're not stringing borrowers along, giving them a slow maybe, which
Yeah.
ultimately turns into a no. We want to give our borrowers clarity up front. That's why we ask a lot of qualifying questions up front. So our funnel is pretty sharp up front. If we quote 130, 40 deals a week, we might qualify 30. And then of those 30 that would qualify, I might close 15.
Yeah.
And then we have milestone by milestone measurements, but those are kind of the rough numbers.
Okay. Yeah. I don't disagree with you. I know what is desirable to hear from an
Yeah,
investor
both sides.
investing money with
Yeah,
us is
we don't fund
very
anything.
different
Yeah, yeah.
than what a borrower or a broker is going to find exciting. Let's talk a little bit about the infrastructure after a loan closes now versus you had said it previously, like there was just two or three of you when you were a small shop. I don't think people understand how robust our servicing team is,
Mhm.
our draw management. Tell me a little bit about how you've kind of just evolved that whole part of it? Because I think at one time you were doing a lot of it yourself.
Well, yeah, and my first year, I did not do construction loans.
Oh,
I
okay.
did no draw. I thought draws were too confusing. I was like, I don't want to deal with that. That seems like a lot of work, and it is.
It is.
Um, so first year, I would just give like 80 or 90 or 70, 80, 90% of the purchase price, 12%, 4 points. I'd walk the house myself,
Oh,
and
interesting.
like it was funded. No appraisal. I would do the appraisal myself with my own MLS login. I shouldn't say appraisal. I would do my own BPO, my own
Yeah.
my own my own opinion of value, I guess you could say. So that was then. Now we have 600 loans in servicing
Yep.
for a combined principal balance of about 130 million. And I believe the servicing team is 7 or 8 right now.
Hmm.
Um, 2 members just do draws. The rest of the team helps, as liaison for payment information,
Hmm.
ACH, investor reporting, helping you guys out if you need information for selling loans, processing extensions and payoffs. Those 3 things, uh, payoffs, extensions, and construction draws are really they're each their own process, and we do a lot of those every month.
Yeah.
So, like, I think we're processing well over 100 construction draws every month now.
Hmm.
So yeah, that is a so even though we might use BSI or FCI as a
Hmm.
sub-servicing company to collect payments, have a portal, record satisfaction of mortgage, and these types of things, you still need a team to for residential transition loans, for construction lending, you still need a team to do the extra work on top of the sub-servicer. So for us, someone has to look at a payoff, make sure it's right.
Yeah.
Someone has to have a conversation if a borrower needs to extend a 6 to 12 month loan. Um, you know, if a borrower is paying late or delinquent, someone needs to have a loss mitigation strategy, be in charge of that strategy. And if a borrower wants a construction draw, someone has to lead the borrower through that process and make sure we're not over dispersing funds. And so that's what our team does.
Talk a little bit about, because I've had this asked to me recently, is how we're utilizing AI,
Hmm.
um, just in this industry in general. And I think it's actually pretty interesting, some of the things that we've put into place.
Yeah, it's funny. Like AI is like such a buzzword. I try to not fall for the trap of just like let AI do everything and human in the loop. And people just kind of say these things. I don't want AI to be a crutch. I want to use it for what it's good for. So what I think AI is good for is aggregating a ton of information and
Hmm.
delivering it to the user in a way that is palatable. Um, so so we use AI. So we use AI for a lot of things, but to help you write your software code, you can use AI. Claude Code. You got Codex with GPT. That's a very practical application. Of course, you need a software engineer, someone who's technical to make sure that everything's secure, everything's plugged in correctly, everything's functioning, and you can kind of look at those outputs that the
Hmm.
AI is generating. In sales, AI can help you sort of predict which customers are likely to need a loan. It can look at our servicing book and tell you, it can very in a neat and organized way tell you who's requested a payoff, who needs to refinance their deal soon. In processing, um, AI will instruct our team. So I'll just give you one example. So we have AI skills that will help our team look at documents in a loan and make sure that everyone's processing that document in the same way. AI is very good at checking for typos, where a human might miss an extra comma somewhere or a space. AI is awesome at data validation. Judgment, on the other hand, AI is kind of hit and miss. Some of the judgment that AI renders is pretty cool. And other times it's like, that's a bit of a hallucination, or it saw more risk here than there really was. Um, we have a we we've built it. We've geeked out on a lot of like AI applications. One thing that we do is we load a borrower's credit report. We load a borrower's background check into AI. We also load a borrower's track record into AI. And then we will have the AI um, basically do a Google search on the borrower. And then it'll create like a risk score, and it'll present the borrower's analysis to me in a way that's consistent and concise each time I qualify a loan. So that's very
You
helpful.
guys were reading those today when you were
Yeah.
qualifying those
Mhm.
loans. It was interesting.
And so, yes, I just I worry because I don't want AI to make people lazy.
Yeah.
Um, there's a certain way to use it correctly, and I think we're all trying to figure that out. But certainly, it can make you more efficient. But you don't want to. You still need to use critical thinking skills on
Mhm.
top of the technology. But I think you can use your critical thinking skills with the information it brings to you. Query your systems, go back and forth, and have a dialogue, and it's really powerful
Yeah.
stuff.
We use it in capital markets because we have several partners
Mhm.
and they all have different guidelines. And so instead of sitting there and trying to analyze a deal and determine which capital partner it should go to, Brad has built out skills, and
Yeah.
within a couple minutes, it will tell us this fits their credit box, this doesn't. And so we can make quicker decisions
Mhm.
on where to send these types of assets. So I agree with you. I don't think I'm not of the opinion it should replace people per se on the human side of it, because there's some judgment things that I still think humans should make. But I think it definitely can organize data, give us a clearer picture very quickly than
Mhm.
even spreadsheets, from the fund management, financials, and things like that. We can run analysis and comparisons quarter over quarter. So what time is it?
It looks like you got questions in there. What do you
Do we have
think?
some questions?
Yeah, Kate, go. Why don't you? I just saw that on the screen. Why don't you kind of give those the priority while they're popping in, just
Oh,
in case
hey,
people have to
Joseph.
leave. Oh.
John.
Have a vision to really expand and grow. Oh, are you pulling the question up on the screen? Oh, cool. You want to read the
I can't
question?
read it.
Oh, I'm gonna
I can
s- I'm,
hardly see it.
I'm gonna squint. So it says, does Andrew have a vision to really expand and grow the company? What does that look like? If he does the vision include expanding into similar lending space? Yeah. So yes, we are looking to grow originations, grow profitability. What's really interesting about lending, and it's kind of brutal, honestly, is like if you're a smaller lender, bigger lenders try to cannibalize you. They basically use their mass and their weight against you. So what I mean by that is bigger lenders normally have a lower cost of funds, and they will normally use that lower cost of funds to compete you out of the market. And then the smaller lender, which is kind of like where we're at, is we might have like a little bit higher cost of funds, and we try to beat the bigger lender through service and speed
Mhm.
and relationship building and these types of things, certainty of execution, right? If I look at your deal today and it looks good, it's going to close next week. You don't have to wait for 15 committees to approve it. So that's sort of the battle in the market right now. We are looking to grow because we are looking to be a more profitable company, and we are looking to get our cost of funds down. Um, but I believe we will end this year between 150 and 180 million of originations. Next year, I would love to be at 400 million. I know it's like a pretty bold goal, and potentially 2028 maybe 750 to a billion of loan originations. So pretty bold goals, but yes, we're looking to grow the company and reduce our cost of funds. And I think through economies of scale, we will be able to be a more profitable company. We have a lot of overhead where it makes sense if we can 3 to 5 to 10x the company, but it might not make sense if we kind of stay where we're at. So we're kind of in this middle ground where we've kind of bulked up with some infrastructure and some team, and it's going to really pay off if we can scale efficiently. But I don't want to stay at the size we're at now, with the team size and overhead we have now. We're
Yeah.
definitely we want to hire ahead, and we want to hire to the pipeline we're building, and not the pipeline we closed last quarter.
Do the borrowers send photos of work done to verify draw requests?
Yeah, who asked that question? John. Awesome. Thank you, John. So yes, borrowers. Uh, so generally, yes. We we have two ways we do draws. So most of our borrowers use a technology. They use an application called SiteWire. It's an application you can put on your phone, and the reason, and there's other companies that do something similar, but the reason we pick SiteWire, or you would use different companies, is we want to make sure that the photos are geolocated and time stamped. Again, fraud is unfortunately um, part of our industry, and if you don't have your controls in place, you can take big losses. So we've heard horror stories, and luckily it hasn't happened to us yet. And hopefully we keep it that way. I've heard horror stories of builders taking pictures of an air conditioner
Mhm.
and sending it to their lender, and it's for a completely different house. So they'll build one house, but they'll use it for 5 to 10 different loans. So you can't just take any photo emailed to you. You can't just take a photo texted to you. Um, we want to make sure our photos are authentic. So we get them geolocated and time stamped. One of the cool things that SiteWire offers is you'll get that geolocated photo, so you know where the phone is located at the time of the picture. You
Mhm.
even see the angle of the photo, and the app will help you walk through the property, make sure that data collection is authentic. So to answer your question, yes, we get photos and video for each draw.
We actually caught a borrower
Yeah,
trying to
yeah, we have.
he took pictures and videos from a different property,
Yeah,
and we actually caught that, so it is pretty
yeah.
useful. And we do use for some draws third-party
Yep.
inspections.
Yeah, so there's companies such
Yeah.
as Trinity
Yeah.
that you can have a third party inspector go to the property. Sometimes you have a borrower that can't get to the property for whatever reason, maybe they're in a
Right.
different state, and they just want sort of a hands off, have a third party go to the property, take notes, kind of do it the old fashioned way. We do have a process for that if that's requested. Um, okay. We got production notes.
What's harder, loan origination or capital raising?
Oh, wow.
So what's harder, loan origination or capital raising? Ooh,
I don't
I'm gonna
know.
have Heather answer that one first.
We'd probably both have different opinions, right? I think that, gosh, I think capital raising, when you have a good product to sell, like our funds, is an easy job. I think investor relations is probably a little harder than the initial capital raise. Um, when you have a strong product, a fund that has a great track record, and you have kind of all the checks and balances, audited financials, you're using, a fund administrator, that makes at least mine and Kate's jobs pretty easy. I honestly think that loan originations is probably harder than capital raising, if I'm being honest.
Yeah, I think it's a tough question. It's just totally different challenges, totally different sales
Yeah.
cycles, totally different, people that these ends of the spectrum service. They're just completely different disciplines. Capital raising is a slow journey. It's a very, very long relationship. Loan originations is extremely transactional.
I was just gonna say
It's
that.
like, send me an application tomorrow and we'll try to close next week. And then if everything goes well, I might not hear from them again. And capital raising is, that could be a 10, 20, 30-year
Yep.
relationship. So,
Yeah.
of course, you want your borrowers to stick around too. But, borrowers, if I'm at 10%, the next guy's at 9.5, like they're gone the
They
next
have no
month.
loyalty. They
Yeah.
really don't. And I was actually gonna say that. I feel like
Yeah.
that side of it is more transactional.
Absolutely.
I've got clients that, I just went and had lunch with one of my guys that has been doing deals with me for 20 years. So, um, it's very relationship driven. But I don't feel like my job's hard. Like I enjoy it. I think if you enjoy it, it's not hard. But
All right, Cade, what else we got on there? Let's see.
Nothing coming in the chat, but I have a few other questions.
yeah,
How do you two think about risk differently?
Joseph has one. Up. Yeah, right there. That one.
Just a follow up to his.
Oh, got it. Okay. What were you saying?
How do you two think about risk differently?
Oh boy.
I don't think we do think differently, honestly. I really don't.
I think you're maybe more conservative than me, just because. Well, so here's the thing about a loan. You can find a problem and you can find a reason to say no to any deal.
So Kate asked how we look at risk differently. He
Yeah.
just reminded me to repeat that. But
Okay. Yeah, it's weird. You can find a reason to not do any deal. You can find a problem in any loan.
Yeah.
And then like I'm like trying to come up with the right equilibrium of like where to draw the line. So, if I'm talking to investors, I would want to look at a reason to say no on every deal, because that protects your capital. But of course, I'm dealing with the sales team too. So
Yeah.
so I have to answer to both sides. And I'm in the middle, like trying to find the middle ground, like, is this too much risk? Is it not enough? Are we losing deals that don't make sense? Like,
and I
you
always look at it like if these
know,
deals go
his cousin
sideways,
has
I
a
got to answer to an investor.
his cousin has a foreclosure, but he doesn't. So is that okay? Like, it's just all this like gray area, So I think because you're on the one side of it, you're
Mhm.
probably leaning a little more conservative, or you're looking at it from that lens. I
Yeah.
think because I look at it from both sides. I look at it from the sales side because I'm in the trenches with those guys. And then I'm also looking at the capital side. I'm trying to be in the middle in a rational
Yeah.
way.
That's probably true. It's true. I also deal a lot with servicing, so I see the repercussions of non-performing assets as well.
Mm-hmm.
And I actively invest in real estate too, and I see how things can go sideways real quick.
Yeah.
So I think we're a good balance, but you're probably right. I am a little more conservative.
We got Isaac in the chat.
Oh,
And
geez.
then we got John with thank you, John. Appreciate that.
Isaac asks, can you recall a time where you bet on the operator? With capital raise, every dollar raised is a bet that we will grow that dollar.
Bet on the operator. I don't know what that.
I don't know what that means.
So here's what I cannot, honestly, I can't, because we don't lend off of trust. We lend off of security. So
He says the flipper or the builder.
yeah, no, I don't believe in lending off of trust. We lend off of, we do secured lending. So of course, if you have perfect credit score, a huge track record, or you have assets, then we're going to give you more advantageous terms because, risk adjusted, we should take more losses. And maybe if we close your loan, we could sell it on secondary for better pricing. So that all feeds into the calculus. But at the end of the day, all of those data points, again, they feed into our risk calculation. And again, we're not lending off of trust. We're lending off of security. So, yeah, I don't believe in like betting on operators.
Yeah. You
What
have other questions, Cade?
do you think?
I got some.
All right, he's got some. You
Okay.
got some. They got some.
I
They're
got a
coming
couple
in.
just to finish up.
All
So
right,
I'm
cool.
good. You go, Cade.
All right, let's go.
All right. If you had to give a 30-second elevator pitch about what central engineers
Oh, geez.
and what they were, how does it change from
Ah.
a borrower to an investor?
Man, I don't want to be a Debbie Downer. I don't like elevator pitches, but I'm gonna try. Okay, so we are standing between active investors that need money to do deals, and passive investors that want exposure to real estate. And we're trying to we're trying to bridge the gap between those two groups of people. And we create value in the market by providing enough value. I think we exist in the market to provide enough value between those two realities, right? If you're a passive investor, you don't have enough time to do the due diligence we do. And if
Mhm.
you're an active investor, you need reliable funding. You don't need to be going to RIAs, finding 50 private lenders and seeing who's got money, next week for your deals. So we're really sort of in the middle, making that economy work.
Heather, your turn.
My turn?
Elevator
Um,
pitch.
I mean, mine would be similar to that. I think what I would say in relation to passive investors, I would say more of our passive investors that are invested with us understand real estate and they've been active
Yeah.
investors in real estate in the past. And they are at a place where they're like, I don't have the time for it and I don't want to do it anymore.
Hmm.
I don't want to deal with tenants and toilets. I don't want to deal with contractors. I understand real estate, and a lot of them have that opinion. I invest in things I understand. They're not out buying crypto or things that they don't understand in. Um, but same kind of theme, right? Like we are matching them with active real estate investors that probably are very similar to them 20 years ago, that are looking for reliable funding. I mean, I personally use private money to do my deals. When
Hmm.
people are like, are you crazy? It's like, I don't have time to deal with the bank. I lend our money too as a private investor. So it's interesting that a lot of the passive investors that I deal with and Kate deal with every day were very active real estate investors at one time in their lives. So
Hmm.
it's a pretty easy sell, right? They're like, I understand real estate. I get what this guy's trying to do. And they like that we're a middleman and they don't have to deal with it. They don't have to call up John because he didn't make his payments and threaten him to foreclose. We provide a pretty concierge service where they can still get the benefits of the passive investing in real estate and funds and notes and things like that, but we handle everything for them. So similar type of explanation.
All right. Give me maybe a couple more. You got a question, or let's see, where are we going? I got
The last one here.
here, there.
Um, last one here from the pre-submitted ones is, what's a rule in the business that exists because of one specific deal? Can you tell us the story?
What's a rule that exists in the business because of one specific deal? Can you tell a story? Oh, geez. What's a rule that exists? Um, I mean, the way I would think about that question is that's interesting because every time we have an asset that is distressed, every time we have a borrower that they list their house, doesn't sell right away, or project goes over budget or whatever, um, we kind of look back at the loan and see like what went wrong.
Yeah.
What could we have seen that maybe could have changed the structure of this loan or declined this loan. Now the challenge with that is when you start adding rules every time something goes bad, now you're not going to close anything because there's a problem with every deal. Um, there's a lot of things we look for. We look for, so it's really not a one size fits all. I could give you 50 things we look for, but I would say um, recent sales of the subject property below what our buyers paying. Really high wholesale fees are high on the list. Any type of property that's like has a half done construction project. Anytime there's an entity that's a seller that isn't like a natural person living in the house, that can be a red flag. Anytime that the borrower is um, maybe they don't own real estate, they don't own their primary residence, they rent where they live, and this is their first deal. You can't find them on any other deals. That's another red flag. So there's a ton of potential risk signals, and we try to look at the deals holistically. So I would say there isn't really like one rule. There's a lot of risk signals that we listen to where we try to that we use to make a loan decision.
And sometimes there aren't flags. We have one right now that is a pretty distressed asset, and the private investor that purchased it said, "Why would you do this deal?" And I went back to the file, like you were saying, just to say, "Did we miss something?" And to be honest, we would have done
Yeah,
that deal all day. I mean, this
yeah.
guy had a track record, he had decent credit, he had money in the bank. Like there, I literally could not find a flag.
Mm.
So it doesn't necessarily mean that there is always something we missed, but we do reflect on those things often. Like,
Yeah, you look for patterns,
yeah,
but you also don't wanna be fooled by randomness. You don't wanna assign patterns and logic and reason to something that isn't real. So you just have to be careful you don't draw conclusions that don't make sense.
okay. Well, we're gonna wrap it up. I got a final question.
Alright.
Uh, so what does someone need to be good at to succeed as a fund manager and an operator?
Ooh, what does someone need to be good at? Hmm. The most important thing by far is your deal flow. If your deal flow isn't good, the details just aren't gonna matter. You can't raise capital for bad deals. You can't administer bad deals. You have to be obsessed with deal flow. I think some people get into this business, they raise this capital and try to do these things, and they kind of figure out their strategy next. You have to start with good deals that create real value in the market.
Mhm.
So I would say that's kind of what we obsess with is our deal flow, and I think any successful operator would have to start from that place.
I like it. Well, any last minute questions online, Cade?
John asks, adjust your LTV to fit the deal.
There's a little bit of that. I mean, there's some deals where it doesn't matter if I'm at 15 LTV. I don't want to deal with the headache but we do make some adjustments to our deals based on things like if the buyer's credit score is higher or lower, if their experience is higher or lower, potentially if the property's in like a tertiary market.
Yeah.
Some of these things would some of these things might be it might not be like a yes or a no. It might be a yes, but it looks like this scenario. Maybe you wanted this scenario, but it's this instead.
I think that's a benefit to managing a fund. You can be
Hmm.
nimble like that.
Yeah.
So, well, we're excited to have Andrew here.
All right.
Tomorrow,
Yeah.
we're going to golf the Coeur d'Alene Resort with the floating green. So, any of you golfers out there, Andrew's going to get to experience that. And as always, if you guys are in the Idaho area or Lakeland, Florida, we encourage you guys to come into the office. But this was fun.
Yeah, yeah, it's great being here.
Yeah.
So happy to be in Idaho. Good studio. We're gonna try and outdo the studio the next one we
Oh,
do from
geez.
Florida. So we're kind of I'm taking notes. I'm bringing the notes home, and we're gonna come back with a Florida episode.
We got competition, Cade.
Yeah.
Well, we thank all of you guys. We know you have families and busy lives, so we appreciate everybody being on here live with us and the questions. And as always, if we can help with your funding needs or you're looking to deploy capital in alternative investments, Kate and I are happy to talk to you about that. So until next month.
All right. Thank you. Thanks everyone.